now let's talk about wealth. Frankly, finance can be a very boring subject, but it's necessary to talk about money. Money is crucial to our survival. It's crucial to the important things like security. It's important to our retirement. It's important to our legacy. So I'm going to try not to make it boring, and I'm going to talk about the stories of success and some of the basic fundamentals that you can utilize as you go forward to make sure that you're financially successful with your wealth. There's a big difference between materialism and success in the financial realm. Security is the most important thing that I find. When people are secure with their future and with what they have, they're generally much happier people than those that have worries and concerns about where they're going to pay their bills or what's going to happen to them when they stop working. Those are the major concerns. 80% of the people in this country are worried about what's going to happen to their money, what's going to happen with inflation, and it's a general consensus that's a constant drip of stress. So let me just clear some things up with some stories from my 30 years in the business. If you're younger and you've got a long career ahead of you, I can tell you, you're not going to be able to probably depend on real estate like your parents did and grandparents. They've had a great run for a long period of time in housing and in real estate. Prices are at such a place that it's probably not going to be a boom going forward. So you're going to have to depend on financial assets and financial markets. That being said, there's going to be a huge wealth transfer that takes place over the next 20 years. There's 10,000 baby boomers retiring every day. That means that there's going to be 10,000 baby boomers passing away every day at some point. Simple math. There's $103 trillion that's going to pass from that generation to the younger generations, and they're going to have to know what to do with it. So if you've got that career, the most important thing for yourself is to be in control of your destiny. And the way to do that is spend less than you're making and invest as much as you can and still live your life in your retirement plan, your 401k at work. I have had countless number of clients that have come to me that have gone through 25, 30-year careers, starting with very little, under $100,000, and having a couple $1 million over that period of time by simply doing that, simply putting $15,000 a year into their 401k plan, investing prudently in something like the S&P 500 in blue chip stocks, and continue to fund that and stay in the market through the downturns. And that has been an effective strategy for them over long periods of time. So that's for the younger generation. As you get closer to retirement, you're going to see where it's time to really start to pull back the throttle a little bit and start going into a mode of having some protection so you don't go through some major downturn like a financial crisis that really wrecks your future as far as your retirement plan and your retirement funding. I can tell you stories, I can tell you all kinds of things about clients that have come to me and done this, but it's really simple. Save on an automated basis where you don't see the money every paycheck for the rest of your career, and don't touch the retirement account. That is one of the things that I teach people. That's one of the things that I wish I would have done. I actually tapped into some of my retirement funds when I was in my early 30s. And it was a mistake because compound interest is the eighth wonder of the world, as Einstein says. And a lot of that money that was only worth $15,000 then would have been hundreds of thousands of dollars 30 years later. If I would have bought McDonald's and Microsoft when I started in this business, I'd have my own island right now. The best way to beat the market or to have great returns is to buy great companies and hold them for a very long time. I had a story. I was the manager at the Merrill Lynch office, and one of my jobs was to take calls from people who wanted to have, well, they had a complaint about their current advisor and they wanted a new advisor. So I answered the phone one day, and this guy said, "I need a new broker." I said, "Why is that?" He said, "Well, this guy continues to call me to sell securities, and I don't sell, I only buy." I said, "What's your account number?" When I looked at his account, he had never sold a stock. And over the last 20 years, he had better performance than any money manager that I had seen on Wall Street, because he only bought blue chip stocks and held them and didn't sell them. That's Warren Buffett's strategy for success. Buy quality companies and hold them for the long term. That's how you grow your assets. Next, I want to show you the value of long-term investing and the ups and downs that happen in the market, so you know what to expect when you're going through this process. As you look at the chart in front of you, you can see that going back to 1996, the S&P 500 was around 700. It stands today at about 5,200, so you can see that it's been a strong 700% plus growth rate over that 28-year period. During that time frame, though, keep in mind that there's going to be tests along the way where you're going to be tempted to either sell stocks or stop funding your retirement account like we just talked about. When you look at March of 2000, the market was at 1527. It declined 49% in about 2 years. The best thing you can do during that period of time is continue to fund your account, because you're buying cheaper. And it's going to go back up over a long period of time. You can see the same thing happened in 2007 during the financial crisis. It dropped 57%. That gave you an opportunity to continue to buy stocks. If you're a long-term investor, buying them cheaper, it's called dollar cost averaging. What happened to a lot of people was they panicked out of the market after it dropped. When it was down 25, 30%, they gave up. The problem is, once you sell it, it's really hard to know when to get back into the market. So if you have a long-term time horizon of 20 years, you want to continue to buy. And as you can see, they were rewarded richly from the bottom in 2008 until now with an 8-fold increase in their assets. So if they had $250,000 at the bottom, they've got $2 million now in that window of time. And that goes a long ways toward funding the retirement. And that's the ups and downs you'll see when you invest for the long term in the stock market. So expect it, know how to handle it, don't panic, and you will win in the long run. Well, you made it through that one. The next module is on budgeting.